retirement interest group, retirement funding interest group, formerly the stocks and share group. Now today I'll share with you this this topic which I've done about 10 years ago, whether investment is it gambling or not gambling, or is it speculation? Right. As per usual, I will have to put out a disclaimer that this discussion or talk is for education purpose only. So nothing presented in this talk should be construed to be a recommendation to buy or sell any specific security. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Singapore Microcomputer Society and its executive committee have no liability for any investment decision based on the use of software or trading strategies or any information provided in connection with this talk. All right, the menu for the day. Trading is not gambling. So whether at the end of this discussion you all agree or you don't agree. So let's look at what you mean by gambling. Gambling is defined as a wagering on a game of chance. That means just like you flip out a coin, either you got head or tail. This is a game of chance, with no skills involved. I mean, technically that is true, but of course, behind any of these game of chance, there are always professionals who are able to use certain super tricks to tilt the chance always in their favor. So, whereas when we talk about trading, effectively when we talk about trading means winning stocks takes skill. And there are systematic ways to beat the market. So this is not just pure luck. Trading, especially day trading, is an attempt to capture small move in the price of a security over a short period of time. This is a very so-called popular with those people in Korea, Japan, and USA, and to a certain extent in the Asian or ASEAN market also. When we say investing, you have to have money to start with, or capital, and you put your capital at risk over a longer term duration by participating in the success of a business. We are talking about stocks and shares, so normally it's equity, mostly common stock investment, or loaning of your funds to a business or government entity to obtain higher rates of return. And this is normally typically like something like bonds or fixed income instruments. The biggest reason stock investing is risk-taking and not gambling is that it is not a zero-sum game. When we say zero-sum game is primary, that means you either, let's say you put a bet on $1, at the end of the day, either you win something or your $1 is disappear or gone to the banker or to the organizer of the pool. As an example or illustration, let's say you and 3 friends sit down and play mahjong all night. In total, you each bring $200, so the size of the pool is $800. At the end of the night, if you add up anyone's money, it's still $800, regardless of who wins or loses. When you invest in a business. Capital raised by selling stocks provides the company the means to perform its business, and the business then makes something or mine something or grow something to provide a service. Net balance, the company gains certain X dollar and the customer receives X worth of goods and services. If the business goes well, the shareholder get a benefit either through the business they own, expanding, paying or getting dividends, or buying stock, leaving you own a greater share. Now, let's look at the odds. We have to understand odds. And I think at the end of today's meeting, I hope you all will have a better understanding of what I call the various type of odds. So whether you enter into a 4D betting or total pool getting or big sweep, you should go and find out actually what are your odds. Normally, when the odds are very so-called to your disadvantage, the prize money looks very attractive. So it makes the so-called the poor man come forward and hope and buy another hope and hope to so-called able to hit the jackpot. So generally, let's say you have a toss a coin. You have a situation whether it's head or it's a tail. So either you win or lose. Excuse me. On hold first. Hello. Okay, sorry about it. So the odds are always not to your favor. Okay, take for example, we talk about in a situation where you win, you have one, you lose is also one, and break even is also one. So finally, the chances whether you win or lose or break even is 1 out of 3. So it's a 2:1 against you. So that means you can either break even or you can, that means when you break even, then you neither win or lose. Then the odds is still 2:1. So on the longer term, normally because of this disadvantage of the odds, you will find that uh, your chances of so-called having your pool of funds continue to grow or to stabilize is not going to be good, because when the duration is longer, because of the odds is not to your advantage, you will gradually lose, and all your capital will be wiped out. This is the one that I think most of us will be interested to know why, if you happen to walk into the casino, what are the odds that you are playing against the house? So odds is the ratio of favorable outcomes to unfavorable outcome. So the probability equal to the ratio of favorable outcomes to the total number of possible outcomes. Just now the one total possible outcome, win, lose, or break even, is 3 outcomes. So the probability is you are 1 out of 3. So the odds, when you play the baccarat, you play the type of game they call it banker player. If you bet on the banker, your house age, that means the odds, the slight advantage that casino or the house, the organizer of the game over the player is you have 1.17%. So if you play, that means you bet on the banker. And if you bet on the player, your odds is worse. the house have a 1.36% over you. So as you go along, you will find that, take for example, quite often we play the Keno, it's something like those Toto like that, you know, you mark a piece of paper and then another number they call, like, so the odds is the house have a 25% edge or odds over you. And there are some other games in some casino, they have let it right. They have, like example, you play poker, your odds of the casino over you all along is they have a 2.5% advantage over you. So Lorette is 2.7%. So this is the most interesting part, slot machine. You know, even at football club or you go to Safra, this kind of clubhouse, or you go to some of the members club, you find that, okay, I bet 5 cent machine, or you go to Genting, or whether Resort World Sentosa, or you go to this MBS, no? Marina Bay Sands. So if you bet on a 5 cent machine, so the casino has a 15.2% advantage over you. Whereas you bet on a 25-cent kind of bet, the house have 10.2% advantage over you, and so on. So if you bet on the bigger, so-called, if the stake is higher, the machine, example, $100 per bet, then your odds against you is reduced. So you notice that there are some big punters, they always bet the maximum that machine allowed, no? Because they feel that the chances of winning is better than you bet on the 5 cent machine. That is because of the odds. So they know that before you participate in any of these so-called punting game or gambling game, you have to understand the odds. Then you'll know why sometimes it turn out this way or that way. Right? Just now I already mentioned this one. Okay, next we look at the social and economic perspective. Investing is widely regarded as the engine that drives capitalism. It tends to put money in the hands of those with the most promising and productive use for it and drive the economy gradually upward. Now, basically investing, you can invest in a listed company that is called where there's exchange rules, allow you to buy and sell by paying a certain commission or fee. There are people also invest in non-listed so-called shares or equity. Those are so-called is a private equity investment, and sometimes they are called pre-IPO investment. So take for example, Alibaba now is going for IPO soon, but there are many people invested in Alibaba share even before they go for IPO. So these are the private investors who put their money in with a higher risk, because not every company have a chance to go for IPO, and even they go for IPO, there's no guarantee that listing will be profitable or really give you multiples many times over your initial investment money. Now that is what we're talking about investing. Trading. Traders do serve a function in the equity market in order to add market depth. That means they add liquidity, transparency, and efficiency. But that's not of relative minor value. And those gamblers probably capture most of the value for themselves. On the other hand, they often increase the volatility of the market, which is on the balance usually a negative, although it does not offer savvy investor opportunity for larger profit. So these traders are what I call like day trader or scalper or market maker. In the US market, they find a market maker. They sometimes they play with all the cards open to them. So the market maker know how many people is on this side of the queue and how many people is on the other side of the queue. So they can actually move the market in the direction that they think they want to move. So if you happen to move in your favor, then you stand to gain. But this market maker, we are talking about not necessarily the so-called the electronic trading system. In the past, a lot of they call it the open outcry system that is quite often practiced in the future markets as well as the U-shares market. Those have a lot of market maker. Even now in electronic system, the exchange also encourage some market maker so that to ensure that liquidity is there. So that means there will be always some people on the buy side and some people on the sell side. Otherwise, the market will not move at all. So next is social and economic perspective. Government generally do not like gambling unless, of course, they are getting the lion's share of the profit side as state lotteries. Many religions also frown on gambling, but they don't seem to mind church bingo. Like even the old folks home, they also play bingo. I have no problem with a person being morally opposed to gambling as long as that person knows exactly what he or she mean by gambling. Buying and holding result in a positive contribution to the economy, but buying and selling quickly, the way day traders do, result in no net contribution. Now, in investing, the odds are in your favor over a longer time frame, of course. Short time frame is not necessarily so. In gambling, the odds are always against you. So Peter Lynch, one of the gurus of investment in the US, has said that an investment is simply a game in which you manage to tilt the odds in your favor. It's simply a gamble. It's something like a gamble whereby you tilt the so-called the game in your favor. There are plenty of investments where the odds are against you. Example, futures, option, commodity trading, on commissions, and the bid and ask spread. So frequent stock trading for the same reason and selling short. So all these short-term traders and punters, they are in a very risky position because the odds are always not to their favor. In and on IPOs at the offering price would be investor, and the little folks that those institutions immediately flip the shares just for a small profit would be gamblers. So an example of it is what I call the stagging. So in the past, whether in Singapore, Hong Kong, Malaysia, you know that quite often when there's during the hot market days in the past, whenever there's a new IPO, everyone scramble to subscribe because they felt that the chances of making a quick buck at the quick listing time is quite good. So many people will subscribe, and then straight away on the first day of listing, or even at the first minute or first hour, they quickly just dump the share into whatever buying price they can get. So these are what I call the stag, S-T-A-G. You know the term they use in the market is called the stag. So they are trying to have a quick punt on the market. Then how can you know for sure whether the odds are for or against you if you decide to buy a particular stock today? Of course, you have to do your homework. If the so-called the manager that manages new IPO issue price the particular share at a certain P ratio versus the market PE for the type of industry. So if they price it at a certain, normally they come up with a range, they also do not know how is the market respond. But if they price it of the lower of the range, then chances are those who participate or those who subscribe for those IPO got a better chance to make some money from the market. If they price it on the high end of the scale, then the so-called the little possibility of a market appreciation of the stock on listing day will be much lesser. So you'll find that it's very difficult for you to have make a small margin or small profit during IPO hunting. Next, the majority of venture capital investment result in loss, often sometimes the total loss of the amount invested. However, venture funds typically yield higher return than stock because a small percentage of the firm's investment are home runs, more than making up for the complete loss of other investments. So this effectively means those venture capital investors, they do not only bet on one horse, they bet on more than one horse. So they also not sure in spite of their so-called expertise or their judgment. So maybe they invest in 10 horses, 10 type of investment. Turn out maybe sometimes 1 to 2 or 3 can make it and make a home run for them or make good money for them. The rest of them, maybe sometimes they end up it's a loss or sometimes total loss can be quite bad also. So because of their ability to diversify or spread the investment out, so their net gain on all this investment is quite positive compared to the small investors where you don't have much capital to spread out the risk. Next thing is talking about some psychological part of this thing we call addictive and disruptive of your gambling habit. Online investors who claim to be buy and hold investors check their portfolios on a daily or hourly basis and jump in and out of stocks more often than they realize. Those who do online trading, online investment. Active trading can be expensive, both in terms of commission and bid-ask spread, in terms of emotional fatigue. Some people invest more aggressively than they should, which is virtually identical to gamblers who bet more money than they can afford to lose. So as a result of this, you can find that those who are hooked on to this type of addictive habit, both will have a negative impact on their health or on their so-called capital. Because if you keep on losing out on your capital, so before long, you may not have much funds for you to play away. Whether investment or investment or gambling or is always about risk taking. There are few investments that don't, and there are few investments that entail risk, such as fixed annuities. Now you buy annuities, almost you will have very little or no risk. Or you buy government bonds, you hold it to maturity. Along the way, you just get your coupon payment. So it's something like fixed deposit, whereby every 6 months you will get paid a certain interest. Both, but even those, you also suffer from inflation risk. Of course, inflation is a issue that affect all form of investment. So inflation is typically because there are too much money chasing too little goods. So as a result, the price of the goods become higher and higher because of the inflation factor. Investors that take only risk, we should only take risks that we can afford to take. While gamblers also take on some risks they shouldn't take. Now, so the difference is investor, you only invest in whatever you can afford to lose or you can afford to lose. That means you must have a certain capital that you're prepared to lose, then you go into a gambling game. I mean the investment game. Whereas gamblers, you heard often, even they don't have the money, they will try to borrow from along or borrow from their families or friends, all this to waggle in the casino, whether it's the official casino or the underground casino. So then they hope to make a quick buck, and then they hope after the result they can return the capital they borrow from people, and then they get a free lunch. But in life, things cannot be so easy or so taken so lightly. So example, this would you rather have a $50 or a 50, that means I pay you $50, or you want to take a 50-50 chance that this $50 that you don't take will turn out to be $100. So if you take the $50, you are an investor, because you know that that $50 is yours. That means it's given to you, or it's a so-called certain return that you're able to achieve. Whereas if you want to retake a higher risk, it means you don't want to take this $50 prize money or this $50 reward, but instead you want to go for all. That means you want to make more or nothing. This is the typical gamblers type of mentality. So gamblers, they don't mind. They say, so what if I lose my capital? But more important, I want to look at the reward. So if you expect to double your money quickly, whatever you are doing is probably gambling. Even it happens on Wall Street rather or rather it happens in Las Vegas. So Las Vegas is one of the biggest casinos before this Macau came out. So Las Vegas used to be even now is a desert area, but because of the casinos, they brought so much wealth into the area. So from the time measurement or time horizon to evaluate, investing is a continuous process, whereas gambling is an immediate event or series of shorter events. Because investing, you have to deploy your capital in search for continuing increasing net worth. Gambling is a specific act or series of acts centered around immediate gratification. So whether you bet black or white or black and red or black, you bet this or that color in some board game or in some lottery. So the outcome is more or less straight away you know already, very short while. Else you want to buy into a share and hold it for a while before the company make money and then can pay you dividend and then or give you bonus share. These are a longer term type of business venture. Day trading resembles gambling. The participant get in, the price move up or down, and he get out, usually in a matter of minutes. So this day trading, normally the participants will have very powerful computer to help them to execute an order. Of buying with the belief that the stock is about to jump, or buying IPO share with the intention of flipping them in a few hours or days, or buying options which are close to expiration. Now, on this flipping, this situation, those of us who are familiar during after the Super Bull run in 1983, 84, so 85, 86 period, or even around 83, 84, 85, you heard of people who buy a property, or let's say at $100 a number. At the end of the year, within 1 year, they can double up their $100 to become $200. I mean, theoretically speaking, in terms of X dollar. So this is a very so-called happening during the boom day, when the stock market boom, the property market boom time. So you find people flipping. That means they are just jumping in and out of the market on a very short time duration. Of course, as you know, buying and selling properties or those hard asset, where you take time for that asset to grow, because property prices cannot so-called double so easily, because you know your earning capacity or the earnings of of employee. You won't get so-called your income increase. When you work for somebody or work for a company, you won't get your salary double up in so short a time. It will take years for your salary to increase gradually to reach a certain point or double up. So if the affordability of the particular asset class, maybe a property, is such that if it double, that means the demand is so strong that the market participants are prepared to pay even double the initial price as been sold in the early part of the year. That at the end of the year, there are still buyers or investors interested to buy over from you, because they also hope that the musical chair hasn't stopped, so that hopefully next year or following year they will also can flip the property and make a quick one. And then during those days, the government haven't, I mean, in terms of Singapore government, we haven't introduced out a lot of this property curb measure or certain restriction where you have to pay additional stamp duty, or you sell within 4 years, you have to pay your property gain, your so-called your capital gains resulting from the transaction will be shared with the government, because the government don't want you to speculate so much on the property market, making the property prices going haywire. So it will come to a point whereby the affordability level of the property for the average citizen is going to be very tough. So normally for this hard asset, although very big ticket item, like example, property or shop, it's not so common or so easy to flip, because it involves very big capital, and then the next buyer must have also ability to afford to have the money to buy. And then if they cannot, the banks who borrow or lend them the money will also make sure that they must able to put down quite a percentage of down payment before they will so-called lend them the money to buy the property. I mean, during those days, the bank are quite relaxed because the government didn't control very much to early days. So the bank also will allow you to borrow the maximum, and as a result, the amount of actual capital required to participate in this flipping of property wasn't that much those days. Some people say as low as $10,000, you can start flipping, for 800,000 or $1 million property. So because the rest of it, they come out can secure financing for mortgaging, and sometimes even the queue position to buy a property can be also traded. That means somebody, in order to jump queue, they will pay you a certain amount. Okay, I give you $100,000, I mean 10,000, or give you $2,000, $1,000. You just sell me the queue position so that I can be earlier in the front queue, so that I can grab the better units, and I can thereafter flip the property easier because they have the choice unit. So buying in the belief that a stock price will eventually reflect its value, with the plans of holding it as long as it takes, it start to feel more like, investing should require more purchase or asset which either produce a stream of income that can be made to produce a stream of income, or can be. So another thing is, many people buy on tips or rumors or based on some analyst price target without doing their own exhaustive research. It feels like right to call such behavior gambling. Because investing is basically, you have to base on skill and require the use of system based on research, while gambling is based on luck and emotion. Next, investors who are making decisions based on emotion, especially greed and fear, rather than remaining emotionally detached and sticking with their strategy, are to some extent gamblers. Gambling. Professional sports investors devote 12 hours a day or every day to handicapping sports. They read thousands of newspapers, subscribe to line services, and maintain inside contact and have years of experience. So these are the professional sport investors. Like those people get betting on the race horses and everything. So every morning they bring the binocular to do the so-called the race course, the test, the so-called the track, to see how the jockey will test out the horse. So and each one will evaluate on the what called the form. They always like to look at how the form of the horse, so that when they will come the weekend race, when this loss is being put up for the race, they will know, the professional so-called those sports investor were able to make some judgment. What are the possibility that the horse will come in? Of course, this is the theory part. The practical part, many things can happen. I mean, the jockey in cahoot with some of the owners, or cahoot with some other opposite stable. I mean, horses are owned by people. Some are group of stable. They own number of horses. So sometimes they will cahoot with other stable or other horse owner, to let some horse to come in and don't allow some other horses to come in. So that's why there's a joke that always bookies always win, because bookie will manipulate the winning horse to their particular liking or dislike. So once they have a system that works for them, they don't second guess it, focusing on long-term profit instead of the day-to-day performance. Okay. Now, what is mean by speculation? As defined by John Maynard Keynes, this economist, speculation as the activity of forecasting the psychology of the market. Speculative motive as the object of securing profit for knowing better than the market with the future will bring. So, speculation is the engagement in business transaction involving or considerable risk for the chance of large gain. So, gamble is the assumption of risk for no purpose but enjoyment of the risk itself. Well, speculation is undertaken in spite of the risk involved, because one perceive a favorable risk-return ratio. So, according to this economist, he's talking about speculation is you have to so-called that you have to what I call do the necessary projection with all the mathematics and all the charting and all those evaluation to understand the behavior of the market, and then from there they will lay their bets on the particular investment. Whereas by and large, gambling is also risky, but they don't care about the so-called the particular higher percentage risk. Sometimes they just enjoy the risk taking, and then as a result, they get burned more than once, but they are still happy because they enjoy doing it. So coming in, the concluding comment is investing. Conclusion about investing is any activity in which money is put at risk for the purpose of making a profit, which is characterized by some or most of the following in approximately descending order of importance. Sufficient research has been conducted. The odds are favorable, the behavior is risk averse, a systematic approach is being taken. Emotions such as greed and fear play no much role. The activities is ongoing and done as part of a long-term plan. Activity is not motivated solely by entertainment or compulsion. So ownership of something tangible is involved. So a net positive economic result. So this is a broad for conclusion about investment. Okay, the conclusion on gambling. Gambling, any activity in which money is put at risk for the purpose of making a profit, which is characterized by some or most of the following approximately the same order. Little or no research has been done. Most often than not, gambling don't need to research. They just hear, I get a good tip from this fellow, and then good tip from the taxi driver, or good tip from the horse owner. So all people bet on tips. So the odds are normally not to your favor. And behavior is risk seeking. So even when they are told that this tip will that means will not 100% will make money, they will still never mind. I'm prepared to take the risk. You know? That is the behavior of the gambler. An unsystematic approach is being taken. So emotions such as greed and fear play a role. So the activity is a discrete event or series of discrete events, not done as part of a long-term plan. So the activity is significantly motivated by entertainment or compulsion. Ownership of something tangible is not necessarily involved. No net income economic effect as a result generated. Because gambling by and large, unless it's a licensed casino or licensed 4D or Toto type of organization, where they will be the way they will also also lah, they all sure win, but they will at least set aside certain percentage whereby the so-called lucky guys were able to have some winners. That's why, as a result, every draw or every other draw, when they say that, oh, the total prize money is 1 million, 2 million, or 3 million, you attract a lot of participants because the odds are getting not in favor as the value go higher, but because the prize money is what attract people. You know, the risk part, nobody will bother, or the odds not available. And often gambling is more out of greed and fear. And, and there are always, you notice that if you go to Macau or go to Las Vegas, most of the casino will provide sometimes very beautiful or very entertaining type of show, dancers and all these things. And is the price money or price ticket of the price for the ticket of the entertainment sometimes may not be so-called too expensive. And for some cases, say for example, some of us may know roughly. You go to Genting, Malaysia, or somewhere Singapore, how often they have invite those some famous singers and performers come in and do the show. So if you are high roller or what, casino will give you a couple of free tickets for you to watch the show also. So as you know, besides gambling, they also will provide you some entertainment or make you feel entertained, right? So by and large, no net economic effect result because most of the punters will lose. The game organizer or the licensed organization to organize the Toto or 4D, they will be the net so will make money. So depending on the particular country or what, you may not able to generate much job for or job for the employment. So as for conclusion on speculation, speculating whether you are investing or gambling characterized by a high degree of risk and high potential for reward. So speculating when you think you are investing, speculating seriously instead of a pastime when you lack proper knowledge and skill for it, and the third part is risking more money in speculation than you can afford to lose. So speculation always, you can speculate all these things as a pastime, and when you have the so-called spare cash to do it, and of course there are a lot of books written also that they tell you how to speculate and how to find the odds to your favor by doing it this way and that way. So risking more money in speculation than you can afford to lose. Quite often speculation, the participants they are so obsessed with it or they are so taken away. So sometimes they cannot be bothered whether they actually have the resources or they can have the money to lose. So finally, the message is we should not take trading as a form of gambling. You should look from the longer term view, whereby you can able to grow your money or grow your capital on a longer time horizon. So that's about it. So now is time for question